second macroeconomic feature of the week stateside will be the latest US Conference Board Consumer Confidence Survey on Tuesday the 28th of February. The overall reading for January was 107.1, fractionally down from December, but the expectations indicator read just 77.8, and a reading below 80 on that one is often seen as a recession warning. Note that both indices are still above their COVID-inspired lows, but neither has come close to recapturing the highs reached in 2018 either. This might play to the argument that the US was gently sliding into recession before COVID, then Capitol Hill and the Federal Reserve jump-started the economy, and now that stimulus has worn off and the original trajectory may just be starting to reassert itself. That's the theory, and we shall see. But it's intriguing nevertheless to see the apparent correlation between the S&P 500 stock market index and American consumer confidence. Normally, a recession punctures the stock market. Maybe this time, the stock market could lead the economy down. We'll see. On this side of the Atlantic, the main feature from a top-down perspective could just be the monthly mortgage approvals data from the Bank of England on Wednesday the 1st of March. In January, that figure plunged to just under 36,000, down by more than a fifth from December and by half from January 2022, as a sliding consumer confidence here, higher inflation, higher bills, higher interest rates and mortgage costs put on their clamps, especially as Help to Buy and the stamp duty tax breaks were long since gone. There's some evidence to suggest mortgage rates have ebbed a little bit, so economists will be looking for any signs the mortgage market's coming back to life, although the prospect of further Bank of England rate rises, even modest ones, continues to lurk in the background. Bottom up, we have a bumper week of results with around a fifth of the FTSE 100 slated to release results or a trading update, and a lot of mid and small caps are due to do the same. Names which may be worthy of further attention include the following, although again, please note some of these dates could still be subject to change. Primark owner Associated British Foods, Bunzl and Senior on Monday the 27th of February. Intertech, Unite, Ocado, Croda, Aberdeen, Derwent London, XP Power and Travis Perkins on the 28th. Reckitt Benckiser, Weir, Nichols, Capital and Counties, Aston Martin, Lagonda and Ricardo on Wednesday the 1st of March. London Stock Exchange, Taylor Wimpey, Haleon, Flutter, CRH, ITV, Beazley, Melrose Industries, Hunting, Grafton, Vesuvius, National Express and Essential on the 2nd. And Pearson, Rightmove, IMI and Elementis will round out the week on Friday the 3rd of March. But even after that lengthy list, the company which could just cause the biggest fuss in the week ahead is Persimmon, the FTSE 100 firm, whose management will doubtless be watching the mortgage approvals data with just as much interest as everybody else, is scheduled to release its full year results for the 12 months to the end of December on Wednesday the 1st of March. The shares halved from top to bottom last year as interest rates rose, inflation rose and consumer confidence sagged, although the shares did then start to rally once the UK started to emerge from the chaos caused by Trussonomics. January's trading update was relatively reassuring about the 2022 numbers, but the outlook for 2023 still seemed pretty murky. The real interest with this statement, therefore, may lie with any comments that Chief Executive Dean Finch feels able to offer about the coming year, rather than the outcome of the last one. The first figures to which analysts and shareholders will turn are completions and average selling prices. Persimmon has steered estimates to between 14,500 and 15,000 completions, against 14,551 in 2021, while last year's ASP was £237,000. It seems likely that price growth is slowing down, so do check how price changes compare to the 8 to 10% input cost inflation that Persimmon was expecting for 2022. At the first half stage, the ASP had, though, gone up to £246,000. Watch out for any guidance on completions for 2023, especially as the builders already noted that average reservations per outlet fell to 0.6 in the second half, and the forward order book was just £770 million for this coming year. Now, attention will then switch to operating profit and operating margin. The margin will be driven by volumes, mix, pricing, costs, and cost efficiencies. Persimmon's operating margin in 2021 was a sector-leading 26.6%, and operating profit was £961 million. For 2022, consensus is looking for £1 billion in operating profit for a 26.4% return on sales, only marginally down. But for 2023, analysts have penciled in a halving of operating profit to 500 million and a slide in the margin to 19.4%. Note that Persimmon has taken an extra £250 million extra provision to cover cladding remediation, and that will hit the statutory numbers. The ones just given exclude those costs. Finally, analysts will look to cash returns. Persimmon returned at 235p a share, or £750 million, to its investors in 2021 and 2022 by dividend payments made in April and July. This figure is seen dropping to 163p in this coming year and 75p a share in 2024. Another benchmark for management's confidence levels will be the land buying budget. After 2022 spend of around £700 million, Persimmon's already steered expectations to a cut as it husbands its cash flow and net cash pile. I hope that you and your families are all in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.